On June 30th, 2026, the executive suites at Nike's massive headquarters in Beaverton, Oregon, breathed a collective, temporary sigh of relief. To the outside world, the headlines were spectacular. For the fourth quarter of the fiscal year, the world's undisputed king of sportswear reported a diluted earnings per share of 72 cents. This did not just beat expectations, it completely obliterated them. Wall Street analysts had spent weeks bracing for impact, forecasting a dismal 11 to 13 cents per share. On paper, it looked like one of the greatest corporate comebacks of the decade. But in the high-stakes arena of corporate finance, as in professional sports, the scoreboard can lie. If you peel back the layers of Nike's spectacular earnings beat, you find a business running on artificial life support. A staggering 52 cents of that 72-cent earnings per share did not come from selling more sneakers, reclaiming market share, or out-innovating high-flying rivals. Instead, it was the result of a massive one-time $986 million tax windfall. A tariff refund. When you strip away this regulatory stroke of luck, Nike's core operating earnings per share sat at a modest 20 cents. Meanwhile, the underlying fundamentals painted a picture of deep structural decay. Full-year revenue had completely flatlined at $46.4 billion. Digital sales, the supposed crown jewel of Nike's future, had plummeted by 12%. And in the critical growth engine of Greater China, sales had contracted by another 12%. Nike is not about to go bankrupt. It remains the largest footwear brand in the world by sheer volume. But it has lost something far more valuable than volume. It has lost its footing. The existential question facing the company is no longer whether Nike can outsell its rivals, but whether it can return to where it truly belongs, at the absolute pinnacle of premium athletic innovation. To understand how the world's most recognizable brand lost its way, we have to look beyond the surface level of sales channels and marketing campaigns. The root of Nike's modern crisis lies in a profound, systemic identity crisis, one that began when the company attempted to replace its athletic soul with digital algorithms. For nearly 50 years, Nike's moat was built on a very simple, almost spiritual philosophy, established by its co-founders, Phil Knight and Bill Bowerman. That philosophy was centered on the everyday athlete. It was a culture built on emotional connections, trackside handshakes, and a relentless, obsessive pursuit of human performance. Nike was not just a manufacturing company, it was a sports company. But as the company grew into a multi-billion-dollar global behemoth, the pressure from Wall Street to deliver consistent, short-term quarterly growth began to warp its internal culture. The financialization of Nike did not happen overnight. The seeds were planted during the tenure of Mark Parker, who served as chief executive officer from 2006 to 2020. Under Parker, Nike launched the Consumer Direct Offense in 2017, a strategic blueprint designed to bypass traditional retail partners and sell directly to consumers. More importantly, this era marked a transition from Phil Knight's relationship-first ethos to a highly transactional, spreadsheet-driven model of sports marketing. Two major cultural turning points signaled this quiet rot. In 2018, Nike refused to match a long-term contract offer from Uniqlo for Roger Federer, letting a once-in-a-generation athletic and cultural icon walk away. The decision was made entirely on short-term return on investment calculations for the tennis category. Then came the public relations disaster of 2019, when Olympic champion Allyson Felix revealed that Nike had attempted to slash her contract by 70% during her pregnancy, without offering maternal protections. The public fallout exposed an organization that had grown rigid, corporate, and profoundly out of touch with the very values of human empowerment it preached in its multi-million-dollar commercials. When the board of directors appointed John Donahoe as chief executive officer in early 2020, they believed they had found the perfect leader to supercharge this digital, transaction-first future. Donahoe did not have a background in sports, design, or manufacturing. He was a Silicon Valley insider, a former chief executive of eBay and a veteran of Bain & Company. Donahoe was brought in to drive Nike down the digital road that Mark Parker had paved, but instead of navigating the curves, he pressed the accelerator to the floor and drove the brand straight into a wall. John Donahoe ran Nike not as a legendary sports company, but as a digital tech and lifestyle firm. Under his leadership, the organization prioritized algorithmic customer acquisition and lifestyle fashion over physical athletic performance. This tech company trap manifested in 5 critical structural missteps that systematically dismantled Nike's competitive advantages. First, the company dissolved the very DNA of its design process. In a massive 2020 corporate reorganization, Nike dismantled its traditional category-led divisions, the dedicated teams for running, basketball, and training. In their place, the entire company was restructured around generic demographic buckets: men's, women's, and kids. By treating athletic performance as a mere subset of demographic fashion, Nike lost its focus. Designers who once spent their days embedded with track coaches or basketball players were suddenly tasked with designing general lifestyle apparel for broad consumer categories. The deep, specialized expertise that had defined Nike for decades was wiped out overnight. Second, Nike starved its research and development to feed its digital marketing machine. As capital was funneled into building proprietary apps, web infrastructure, and high-cost performance marketing to drive digital traffic, the legendary Nike Sport Research Lab was left underfunded. Designers, engineers, and master product developers, the very people who built Nike's intellectual moat, were downsized or left the company. Many of them walked right into the arms of hungry, rising competitors like Hoka and On Running. Third, Nike became addicted to easy money. In the direct-to-consumer model, Nike discovered a highly lucrative short-term cheat code. By flooding its digital apps with endless color variations of 30 to 40-year-old vintage classics, specifically the Dunk Low, the Air Force One, and the Air Jordan 1, Nike generated astronomical profit margins. Because these retro designs required zero modern research and development, they were pure cash cows. But this overproduction had a devastating side effect. It destroyed their scarcity value. What were once highly coveted, premium cultural icons became ubiquitous, heavily discounted commodities sitting on clearance racks. Fourth, Nike created a massive self-inflicted vacuum in physical retail. In its desperate sprint toward a direct-to-consumer empire, Nike systematically severed ties with thousands of its traditional mid-tier wholesale and retail partners. It pulled inventory from regional department stores, local running shops, and major national chains like Foot Locker. But retail shelves cannot remain empty. Store managers, starved for inventory and desperate to hit their own revenue numbers, had to look elsewhere. This created a once-in-a-generation real estate gift for Nike's rivals. Hungry, agile upstarts like Hoka, On Running, and Brooks stepped directly into the prime empty shelf space that Nike had voluntarily abandoned. When everyday consumers walked into a store looking for Nike and found nothing but empty racks, retail associates guided them toward On's Swiss-engineered clouds, or Hoka's plush, maximalist cushioning. In trying to control the customer relationship through an app, Nike handed its physical relationship with the mass market directly to its competitors. Fifth, this lifestyle obsession created a hollow middle. Nike successfully maintained its elite sports authority at the very top of the market. They continued to dominate professional marathons with ultra-expensive, record-breaking shoes like the Alpha Fly, which sold for over $280. But this elite tier was used merely as a marketing shield, a way to project athletic credibility while the core product line was neglected. The real casualty was the everyday athletic performance segment, the crucial $130 to $160 price range. This is the heart of the market, where everyday runners, walkers, and fitness enthusiasts look for comfort, cushioning, and durability. While Nike's designers were busy pumping out lifestyle retro releases, its mid-tier daily running lines, like the Pegasus and the Infinity, stagnated for years with outdated cushioning technology. This critical oversight allowed Hoka and On Running to easily conquer the market and rapidly strip Nike of its premium mass-market identity. By the time the board realized the gravity of the situation, the damage was done. Nike had voluntarily walked away from its wholesale partners, alienated its core athletic audience, and cheapened its most valuable assets. To fix a multi-billion-dollar crisis, you have to swallow your corporate pride. In late 2024, Nike turned to Elliott Hill, a 32-year company veteran who had originally joined the brand as an apparel sales intern in 1988. Hill's strategy, known as the sport offense, is an exercise in rebuilding broken foundations. First, Hill has launched an aggressive diplomatic mission to repair relationships with alienated wholesale distributors. Nike is actively redistributing its premium inventory back to Foot Locker and other major retail partners. The company has publicly acknowledged that an integrated marketplace, where consumers can touch, try on, and buy shoes in local stores, is vastly superior to a closed digital loop. Second, Hill is dismantling the demographic silos. He has restored the traditional sport-specific divisions, putting designers back into specialized rooms focused on running, basketball, and training. Finally, Hill has initiated a painful but necessary product purge. Nike is deliberately and aggressively cutting back the production of its oversaturated retro models. By restricting the supply of Jordans and Dunks, the company aims to dry up discount channels, restore the health of the secondary market, and revive the brand's critical scarcity value. But how will we know if this turnaround is actually working? The answer will not be found in top-line revenue growth, which is expected to remain sluggish as Nike undergoes this painful transitional cleansing phase. Instead, professional analysts and investors must watch two critical leading indicators. The first is the core gross margin, isolated from one-time tax anomalies. A true operational recovery will see Nike's gross margins consistently climbing back toward the 49% range, driven entirely by a reduction in promotional markdowns. If Nike can sell fewer shoes, but at higher average selling prices, its premium status is returning. The second metric is the full price sell-through rate. The ultimate test of Nike's resurrected pricing power will be how quickly its newest performance innovations, such as the upcoming Pegasus Premium with its sculpted, three-dimensional molded Air Zoom pods, sell out at full retail prices of over $200 during their initial launch windows. If consumers bypass these premium offerings to wait for seasonal clearance sales, the turnaround is failing. Ultimately, Nike's crisis was never just about supply chain logistics, organizational charts, or direct-to-consumer software. Those were merely the physical symptoms of a deeper strategic and cultural disease. The fundamental question facing Nike is simple, yet incredibly profound. Are consumers still willing to pay a premium for the swoosh? To maintain its incredibly lucrative position as a premium mass-market giant, Nike must restore a delicate double equilibrium. This is what makes the premium mass business model one of the most difficult tightropes in global business to walk. It requires keeping two separate, highly sensitive scales perfectly balanced at the exact same time. At the product level, it must balance functional value, delivering undisputed physical performance comfort that everyday athletes can feel, with emotional value, crafting narratives of inspiration and personal triumph that make consumers wear the brand with pride. If a brand delivers pure functionality with no emotional soul, it becomes a cold, clinical utility, a specialized tool that appeals only to a niche group of hardcore purists, completely losing the broad mass market. But if it relies entirely on emotional hype with no underlying physical innovation or quality, the illusion quickly shatters. Customers who buy into the marketing will inevitably face the harsh reality of subpar performance, and they will return to the internet to leave scathing reviews exposing the product as cheap, low quality, and severely overpriced. At the commercial level, it must balance volume, the massive scale required to feed its global manufacturing footprint, with pricing power, the strict discipline of maintaining scarcity and brand equity. If a company tilts too heavily toward volume, churning out millions of units just to meet short-term sales targets, its pricing power evaporates. When you lose pricing power, your profit margins shrink, and your premium brand image is destroyed. More critically, without those premium margins, you lack the excess capital, the massive financial war chest, needed to reinvest in research and development, fund cutting-edge innovation, and secure top-tier athletic sponsorships. In short, your competitive moat dries up, and you lose your long-term survival advantage. But if you swing too far in the opposite direction and guard your pricing power too aggressively, you lose the mass in premium mass. A global giant like Nike cannot survive as a niche, ultra-exclusive luxury boutique. The company operates a gargantuan, multi-billion-dollar global machine. It has thousands of retail stores, massive supply chains, high-cost factories that demand continuous throughput to remain efficient, and billions of dollars in active marketing commitments. If Nike restricts its volume too much to chase hyper-exclusivity, it cannot generate the absolute cash volume required to feed this massive overhead. The corporate beast will choke on its own fixed costs and suffocate before it can ever turn around. Now, to be clear, chasing short-term Wall Street expectations is not inherently wrong. It is the stark reality of leading a multi-billion-dollar public corporation. But the danger arises when you allow Wall Street to dictate the scales. If you tilt the balance entirely toward volume just to satisfy next quarter's targets, you don't just affect your sales sheets. You break both of these crucial equilibriums simultaneously. By overproducing and discounting to force volume, you destroy your pricing power at the commercial level. And once those premium profit margins collapse, you starve the research and development budget at the product level, rendering you unable to build the high-quality functional innovations that justify your premium price in the first place. You boost your short-term numbers, but you trigger a self-reinforcing downward spiral that erodes the entire brand, causing a level of structural damage that takes years and billions of dollars to undo. Ultimately, success for Nike's new leadership will not be defined by how quickly they can cut costs, nor by how fast they can appease wholesale distributors. Those are merely mechanical and tactical fixes. The true victory will be measured by their ability to master this delicate high-wire act, re-anchoring the cold, spreadsheet-driven business of a global giant within the authentic, performance-first soul of an athletic powerhouse. Because when a premium mass brand is perfectly healthy, these forces do not fight each other. They feed each other. Physical innovation justifies high pricing power, and inspiring emotional storytelling drives massive global volume. If Elliott Hill and his team can restore this harmony, pulling the brand out of the pure spreadsheet trap and back into this masterful balance, Nike will do more than just survive its current financial slump. It will reclaim its identity, find its footing, and return to where it has always belonged. If you found this deep dive into Nike's structural turnaround valuable, please hit the like button and subscribe to the channel for more business breakdowns and financial case studies. We want to hear from you in the comments.